What's up, Facebook fam, social media fam? This one might be a little long too. We are officially in like a coronavirus epidemic right now in the mortgage industry. It's kind of a perfect storm. Rates are still low. You can still get in and refinance or purchase a home, but there are a lot of obstacles here. And I just want to be honest with everybody about it and completely clear that we're probably looking at something pretty unprecedented in terms of just the amount of overall damage. I think it could exceed what we saw with mortgage companies even in 2008 with the financial crisis. And there's a number of factors going on here. It's a lot of information. I don't really know what's relevant to everybody, but let me just say this: we are going to have a huge cash crunch in the mortgage industry. I've been talking about it here for the last couple of weeks, but it's really coming to fruition. And um, it's starting to affect guidelines where companies are shutting off riskier loans. We are raising minimum credit scores for FHA loans. There's really no FHA market for servicers right now because of some of the rules and the forbearances that are pending based on the coronavirus. So I'm just going to kind of really quickly touch on all of the different factors that are coming into play here. First, the amount of cash mortgage companies have on hand is directly related to their ability to just lend. It's a leverage thing in terms of their capacity on their warehouse lines and on their credit. When we have mortgage companies service loans, basically in order to for the right to service a loan or collect payments, mortgage companies will pay roughly 1% of the total loan amount. And then they collect annually about 30 basis points for servicing that loan. So the break even point's about 3 years in. With the rates dropping the way they have and the Fed coming in and saying they're going to buy an unlimited amount of mortgage-backed securities, what's happening is a lot of people are refinancing in less than 3 years. Even just the specter of people refinancing in less than 3 years is enough where these companies have to devalue their servicing portfolio. And right now the value's been cut in half, which means that from a leverage perspective, the value of these servicing rights has been cut in half, which is causing both long-term and short-term financial damage to these mortgage companies. In addition to that, we have increased volume, which puts more pressure on those companies. And we also have huge hedge cost problems. When you lock your mortgage rate with your mortgage lender, what that mortgage lender is actually doing is they're making a bet. They're betting that mortgage rates they're going to preserve your rate. And if rates go up, they're going to make a bet, I should say, on the stock market or against mortgage-backed securities. So that if rates go up, even though that lender is going to have to spend money to get you that same rate, they'll make that money back on the bet they made that mortgage-backed securities were going to go up. When rates move down, we lose that bet as the mortgage company, but we actually make more money when we sell your loan on the secondary market. And so what's happening right now is that the rates have gone down. Mortgage companies are having to pay out money for these huge bets they lost before those loans are even closing. And that's a huge cash crunch. What's making that even more impactful is that when the Fed came out and announced that they were going to lower rates to zero, we saw a lot of people that had locked in with these other lenders decide they were never going to close. So not only did the lenders have the downside risk of having to lose the bets on that rates were going up and having to pay that money up front, but now they may never have the added gain of closing that loan because the loan may never actually close. So this is it. All of this is being combined when you factor in losing half of the value you have on servicing. By the way, some of these companies have billions and billions of dollars in servicing that's valued at tens or hundreds of millions of dollars. The value being cut in half overnight, unthinkable in terms of damage to the company. When you factor that in with these loans, the turnover on these loan portfolios, the hedge cost losses that we have, the amount of volume that these companies are experiencing right now, all of it is apocalyptic. And then added in that we have about a quarter of the population that may not make their mortgage payments next month because of the coronavirus and they're being furloughed. And those mortgage companies now still have to deliver those expected payments for FHA, VA, and USDA loans to those securitization pools. So whether the borrowers pay or not, they have to come up with those payments and deliver them to somebody. That could essentially be billions and billions of dollars over the next couple of months. And I've seen numbers between 40 and 100 billion over the next 3 months that could be that mortgage companies are going to have to lay out in advance of those payments. And we have people on the news telling people they don't have to make their mortgage payments as part of these forbearance agreements. When you factor all of this in, we don't know. All of these things together, it's an uncertainty. I actually just got chills a little bit as I said it. The answer is we just don't know which companies are in jeopardy, how in jeopardy they are, and what the ramifications of that are going to be. So I say this all from the relative comfort of working for a company that does not have servicing, has already paid off those hedges, is a cash company, and is relatively small. So the delivery on these loans is going to happen, and we look like we're in pretty good shape. But from an overall industry perspective, it's very concerning right now. And so for you guys who work for companies or out there that, have a bunch of servicing and exposure in that sort of a way, especially if they're servicing Ginnie Mae pools, so FHA, VA, USDA loans, it's time to start asking questions because you want to figure out where you're going to be and how this stuff is going to shake out. I'm not trying to be an alarmist. I don't really think I am being an alarmist. Barry Habib, who's one of the experts in the industry for MBS Highway, put out a newsletter today breaking down everything that I just talked about here. I don't mean to say that I'm certainly not the only one talking about this stuff, but I do think there's not a lot of people talking about it and putting it out on their normal Facebook feeds for regular people, because this is another industry taking a hit like this in this environment where we had over 3 million initial jobless claims this week. We just don't know what the ramifications of that are. And in addition to that, we saw, by the way, something completely separate. And again, I apologize for the run on for this video. Maybe I'll break it out into 2 videos, but we don't know how to evaluate whether somebody qualifies for a loan while they're on furlough, or if they're self-employed. Was their business affected by the coronavirus? And so we have a lot of people that are getting to the end of the mortgage process here, and maybe they're trying to buy a house, and maybe there's other people that are contingent upon this person buying this house. And that loan may get turned down here at the end because we just don't know how to evaluate that person's income based on the new world that we're living in. So, I mean, that's just on the consumer level. That's probably the thing that most applies to people out there right now that are listening. But all of this stuff is tied together. And so the answer is I'm going to keep doing videos and sharing more information. And I hope you find this interesting. I do get a lot of good feedback on these videos, but if there's questions you have or things you want to see, shoot me a message. Let me know what you're thinking or what questions you have. And if you have feedback on the videos, let me know. But we are in a very uncertain time. I'm sure there's a lot of industries experiencing similar things, but particularly for the mortgage market, and this is a huge piece of the American economy, things are going to get weird. So thanks for listening. I'll talk to you soon.